My guest today is Yuen Yung, a founder partner at HalBar Partners, where they invest in passionate leaders and visionaries while scaling for growth. Thanks a lot for coming to the podcast, Jan.
Yeah, you're welcome, Nick. Good to see you.
In the last 2 years, HalBar and NCA ETA partnership has completed 15 acquisitions through syndication for a total of 270 million in enterprise value, reaching the anticipated run rate of 10 acquisitions annually. First of all, this is remarkable. And doing research on you, you are one of those special people. You have this wild journey. You weren't born in US, you were born in China, and your parents pretty much escaped the communism party and moved from China to US. Your parents had nothing. I found they had like a few $100, but not much. They didn't speak English. So your parents got into restaurant business. So could you please tell me those early days of your life?
Yeah, it's funny because my first recollection was probably 3 or 4 years old. My family had immigrated from China to New York, so that was where we landed, and we were in Manhattan, Chinatown. The early recollections was how bad the living conditions were. Even as a 3, 4 year old, you knew you were really poor, and you knew that things were not in order. And growing up, I was actually very scared of Chinatown, Manhattan. And the reason why is because there's gangs, right? We were just north of Little Italy, and there was gangs. I remember vividly when people at the front door would stop my dad and try to shake him down for money, and how hard my parents had to work. And they were both doing 2 jobs each. And my great grandmother was actually the one who was watching me because I was the only child at that time. And it was one of those where it was like life was tough. Life was very, very tough. And by the time I was 6 or 7, my father finally said, "Okay, this is kind of a dead end. We need to get out of here." And he moved us to Houston, Texas, of all places. The idea of getting away was nice, but the shock of leaving the culture and the people was very challenging. There was not a lot of Asian people in Houston at that time. It's changed a lot now, but at that time there was very few. And so the integration was very challenging. So I remember as a first grader going into school, first day of school, I started crying. I literally just started sobbing in my seat because I didn't know what was going on. The education program wasn't quite there to get me to where I needed to be. I was just lost. And so they actually ended up holding me back for the first year of first grade. And I had to repeat first grade. And it was probably the best thing that ever happened to me. It was the best thing that ever happened to me. And we can maybe talk about this a little further, but failure sometimes is where you learn the most. And it was embarrassing as a little kid to have to repeat first grade, seeing your friends now go on to second grade and you're still lining up in first grade. That feeling was very, very interesting. And I would say that that's where a lot of my entrepreneurial drive and motivation comes from.
First class, you're probably 7, 8 years old, at least in
Yeah, I
Europe.
was about 7. That's exactly
So,
right.
how do you analyze, or what were you thinking of? Do you remember, and what was the lesson?
As a kid, you still are aware of your ego, right? And when you think about your friends that you made in first grade, but then now they're all in second grade, and they used to line us up in grades, right? So you could see where everybody was. And there's all your friends over in the second grade the following year, and here I am still stuck back in the first grade line, and I tried to hide. I was embarrassed, right? Because I had failed. I had failed first grade. But what it did was it lit a fire under me. And what it did for me was that that year of repeating first grade, I was top of the class. I mean, I was just like, I'm never gonna go through that feeling again. And it was that drove me to just try to excel academically all the time because Never in my life did I want to have that feeling of embarrassment of not being able to move on.
So, and how was life from there? One moment your parents started a restaurant business and
Well, they
you
didn't
were
start
working
the
there?
restaurant business. My dad actually, when he moved to Houston, he started working in a restaurant.
Yeah.
And what's interesting is, I guess history repeats itself. But he started working for this restaurant, and he was a hard worker, was smart, even though he didn't have the education background. But he was a good person, smart, hardworking, and the owner really took a liking to him. And a few years later, the owner, who was aging, actually asked to sell it to him, and that's how we ended up owning the restaurant. So when you think about it, that's exactly what I do today, right? With the ETA program, entrepreneurship through acquisition. I find aging founders who need an exit, and I find the younger entrepreneur to come in and take over.
There has been many opportunities in between this from the restaurant to what you do today. One of them being the Shark Tank story. Could you maybe shortly talk about this because you must
Yeah.
be a damn good salesman to do what you did.
Well, it's interesting. Shark Tank is an amazing show. It's a reality TV show that has businesses that pitch to the sharks and decide if the sharks decide whether or not they're going to invest in that business. And we were already a few years into our business when they found us and asked us to join the show. And when we did the show, it was one of those things where a lot of times people don't realize that TV is its own business and it has its own agenda. And so we knew that one of the things that they always wanted was to try to get contestants to cry or show, serious emotion because it made for good TV. And so my brother and I decided, when we go on the show, we want to make sure we don't get embarrassed in any form or fashion. And so we made sure we knew what we were talking about. We knew our business very well. Our business was growing, things were happening. And so we wanted to get on to the show as a way to show that, hey, things are okay and you can't take advantage of me as a shark, right? And the thing that a lot of people don't realize is that you're in front of the sharks for over an hour usually. But what they show on TV is probably about 6 to 8 minutes of the actual hour and a half. We were in front of the sharks for a total of about 90 minutes total. Our episode, if you ever watch it, is only 8 minutes long. So there was, you know, 81 minutes, 82 minutes that you never saw what happened during that time period. So it was an interesting experience. It really was.
And those who haven't seen the episode yet, what was the business and how did it go? The pitch and
Yeah,
everything.
at that time, that was my second startup, and it was a fast casual sushi concept that my brother and I started called How Do You Roll? And if you think about like a Chipotle or a Subway, it was like that, but with sushi rolls. And we felt like that sushi could go into the fast casual space in some form or fashion. And my brother being a sushi chef, we really could figure out that back end of it. And so that was the business that we were in. And we went in there, and originally, behind the scenes, we were going to ask for $3 million from the Sharks. And the producers actually told us, no, 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 you can't do that. You can't do that. And we're like, why? This is a real business. We want this much money to grow. And they said, well, because they've never done a deal that big. And so even if it is a good deal, they're all going to go out. They're all just going to say, well, I'm not giving you $3 million. I don't know you that well. And there will be no show. So I said, okay, well, what's the largest deal that's ever been done on your show? And at that time, this was season 4. At that time, the largest deal that was ever done was about $750,000 between a couple of sharks. They had to combine assets and money to do the deal. And they're like, that was the biggest we did. And that was not from one shark, that was from two, right? And I said, okay, well, if that is the case, I'm going to ask for $1 million, just a nice round number. And they're like, ooh, they've never done a deal that big. okay, we're gonna see how this goes. And so that's what we did. We went on the show, and right off the bat, we were asking for $1 million, and you could see the faces of the sharks, all of them going, "Whoa, these guys are asking for big money," because most people are asking for 50,000, 100,000, 250,000. And here you have these two Asian brothers go on the show, and they're asking for $1 million, right? And so that was what made it interesting. And what happened was the four of the five sharks went out right away. And so I thought, oh, we messed up, right? We went too big, and no one's going to do the deal. However, Mr. Wonderful saw it as an opportunity to go big, right? And he goes, "No, I'll give you $1 million," right? And all the other sharks just went nuts, right? They were like, "Oh my God, someone's going to do $1 million deal here," and so that's kind of what put us on the map. And it ended up being, I think, even to this day, it's still one of the bigger deals that's ever been done.
And to sum up the story, what was going afterward? Did you sell the business? What?
Well, so what happens is after the show, you end up having to do a real negotiation, right? Because it's a real purchase of equity coming into the show, and so we did all the work around that. It didn't end up working out on the back end, so we didn't end up doing the million with Mr. Wonderful. However, we did find other investors in line because they saw the show and they started they were interested in. Now we had a exclusivity period, so we couldn't talk to them right away. But after that period, we were allowed to talk to them, and we found more investors that way. Um, but what happened was the after being on the show, the exposure that we got really grew the business dramatically and really, really fast. To the point where, in my opinion, it got a little bit out of control. It became too hard to manage the growth. So right after the show aired, all of a sudden we got thousands of leads all around the world of people wanting to be franchisees with us. We ended up picking up like 20, 30 of them to open 200 stores all around the world. That growth was very hard to manage, and in the end, we end up just selling the company to a private equity. And so, one of the lessons learned, and if you've read my book, you'll hear me talk about how you can grow yourself to death because you're not prepared for that growth. And so that was one of the big lessons learned from that business, which was probably one of the most high profile businesses I've ever done.
Do you regret selling the business? I'm asking because
No, I don't. I don't. One of the things that I'm very big on is that you can't live life with regret. And it's also very important never to fall in love with your business. It's important to fall in love with your family, your kids, your wife, your parents, your siblings, your extended family. That's where your love should go. A business is a business. And a business is designed to help you create, enterprise value, money, wealth, and it's there to help you do that so that you can then have love in your life, which is all your family and the people that you care about around you. I have seen way too many times as a entrepreneur myself, I've seen way too many times where somebody falls in love with their business more than their family. And that's where you see a lot of divorces. That's why entrepreneurs oftentimes end up in divorce. They end up falling too heavy into that business. And so, yeah, if it's time to sell, it's just time to sell. And you have to be okay with that. You can't hang on because it's only detrimental at that point. And so my philosophy is no, just go build another business. It's okay.
okay. So ETA, search funds, HalBar. Let's start with this. What is the thesis for investors, and what is the core thesis behind HalBar ETA, like direct investment program?
Yeah, great question. So the opportunity came about a few years back, and one of the things that we started researching, I have a master's in entrepreneurship. My business partner Nate has an MBA from Yale. And one of the things we noticed was that this search fund space is what it was called. The MBA programs now are calling it ETA, which stands for Entrepreneurship Through Acquisition. But the search fund space itself has actually been around since like the mid 80s. So it's been around for a very, very, very long time. But what we couldn't understand was when you looked at the numbers, and Stanford does a research on this every other year. When you look at the numbers, it's the highest performing sector in private equity if it was an actual sector. And so what that told us was that, hey, there are some real gains, some real returns by having this model of the search fund model where you found a highly motivated entrepreneur and then tell them to go find a company that fits a certain criteria and then have them have some equity in that deal. They become the CEO, they run the company, they grow the company. And when you look at the numbers at the exits, it's averaging over 35% IRR over the last 3 decades. So we're sitting there scratching our head like, okay, if that's the case, why is it that there are no institutional investors in this sector? If it's the highest performing, why you would think the people with the most money would have figured out, okay, we need to be in here, right? But yet they keep throwing money into venture, they keep throwing money into private equity, but nobody into the search fund space. And so as we started researching this a while back, what we started realizing is that institutions have a hard time getting into this space. And for probably good reason. And that reason, there's probably several reasons. Number one is when they look at the search fund space, the challenge for them is that there is a J curve in terms of the returns for the search space. And what I mean by that is this. You find the entrepreneur, and then you go to that entrepreneur, you say, okay, I'll pay you a salary or a stipend or whatever for up to 2 years, and I'll give you 2 years to go find that company. Well, that's a sunk cost, right? And so when you think about it from institutions' perspective, they'll say, okay, well, that doesn't make any sense for us because what happens is I've got to spend money and hope that in 2 years or less, they find the right company, and then we got to put more money in it and grow this thing. And so that it's just not a space that they're interested in. The other thing that I think bars them from coming into this particular sector is the fact that when you look at institutions, they're not designed or equipped to figure out who the good entrepreneurs are and who the bad ones are. Right? That's not their job. They just invest with things that are already doing well or could do well. And so trying to figure out, these millions of searchers that are out there today who want to be entrepreneurs, who are out there searching for companies, that's a lot of people to sift through, and especially when you don't know what characteristics you're looking for, right? And trying to figure that out. And then finally, I think that the last barrier to entry for institutions in this space is very simply the fact that they have to do a lot of deals in order to get the diversity and the volume that they need, right? So if they're eating salad and it's light and it's small, they have to eat a lot of salad to get full, right? And so when you think about this space, these deals are small. These aren't big, pre-IPO type deals. And so they have a hard time trying to do, $3 million, $5 million into a deal. That's just not their space. And so having said all that, Nate and I sat around and said, okay, well, how do we solve this problem? This is a problem. Great sector. We already knew that demographically, the baby boom generation has created a lot of enterprises, a lot of businesses, and they're all aging now, right? And so now we're like looking at the demographics going, well, these people have no way of transitioning, right? They have no way of exiting out of their business, even though the businesses are good, right? Even though they're good businesses that they built. Because there's a mismatch in capital, people, and enterprise, right? Through that, there's no market for it. And so we sought out to figure out how to solve that problem, right? How do we get institutional capital to come into this space and set up a way to find the best entrepreneurs that we can and to then go find the aging founders that are out there. And we decided, look, we're going to do it. There's so much to tackle there that we decided that we are only going to go and bring on mid-career entrepreneurs, right? So I'm not going to do the new MBA student that just graduated. The risk profile is a little bit higher. Not that they couldn't do well, but the risk profile is higher. And so we decided to go after mid-career MBA folks. The other thing we decided to do was go after businesses that have an aging founder that's already profitable, meaning no startups, no distress, no turnarounds, we're focused on companies that are already making $1 million to $10 million profitability today. Not revenue, but EBITDA, right? Actual income. And so by doing that, what we've done is we basically have found companies where we can buy from an aging founder. Our average purchase from a founder, their age is 72. So that tells you it's up there. The average EBITDA profitability that we are buying at is roughly around 3 million, and we're roughly buying it at 5x. And so you can see that on average, it's about $15 million for us to buy a company, right? Now, once that happens, then the new younger entrepreneur comes in, becomes CEO, and they have a 5-year growth plan, and we expect them to grow that company to at those levels so that we have an exit, somewhere down the road.
Okay, lots of follow-up questions. Let's start with the first one. Your co-founder, Nate Wasson, if I pronounce it correctly, how did you meet, and how did you, like, going into a business with someone, it's a serious move, and raising capital, finding those deals takes a lot of time.
Yes.
There's no guarantees. So how did you know Nate is the right person, and what was the background there?
Yeah, so I've been in a lot of different partnerships in my life, right? From outside partners to my brother being a partner, right? So I've gone through kind of that iteration of partnerships, and here's what I'll tell you about partnerships: they're great when they work well. They're horrible when they don't. It's kind of like marriage in some ways. You got to be very, very careful and selective about who your partner is going to be, because you're trying to build something long term together, right? And if you don't have the same value systems, the same philosophies, and the same vision of where you want to go, that partnership will probably not work out, right? What I've found is over time is my best partnerships have been people that I have known who have the same value system as I do. They see the world in the same way, and they want to do business in the same way, and they care about people in the same way that I do. And through that value system is what makes the partnership sustain and do well. So having said that, so Nate and I were friends first, right? We knew each other through the family office circles, and we talked, and shared ideas. We were friends. And anytime somebody had a problem, we would bring it to each other, and we would banter about it. And that's really what created the relationship first. Then the opportunity came secondary, right? And so, that's kind of how that whole process worked out. And so we were friends for many, many years. We shared ideas, and we knew kind of each other. We knew we were both family men. Our families were important to us. Our kids were important to us. Our wives were important to us. We talked a lot about business and how we thought about business and how we would treat people in the world of business, and quite honestly, the problems that business itself has, especially when it comes to money. And so that was very important. And so that's kind of where we started. And then this opportunity came around. He was really, architecting and studying it, trying to figure out, okay, where the opportunity is, what the problem was to solve. And then I joined him, about 2 years after he was studying it. I joined him to form HalBar to start doing it, right? And start putting it together.
Okay, values. Okay, what about the personality types? What about the skill set? What about the strengths and weaknesses?
That's a good question. So what's funny is in partnerships, the personalities don't have to be similar. They actually can be different. Sometimes you don't want it to be too similar. And so he, for example, he is much more analytical than I am. He is much more the person that gets into the details and loves the strategies and the design. I'm much more big vision, typical entrepreneur, big vision and strategist. Not that I couldn't get into details, but that's really not my comfort level, right? And so we actually are different in terms of personality, but we're not different in terms of value system, and that's the key, right? And in business, you know that right away because and maybe not always right away, but you start discovering somebody's really true value system when you have problems. and when you're dealing with problems. Not when things are good, but when things are not good. And so, we've had some challenges. Growing a company is always challenging, but when given the choice to do the right thing, do they take it? And that's what's been proven in terms of our value system, right? There's been times where it's like, well, legally it doesn't say we have to do it that way, but our value system says no. We need to take care of our investors, and even though we don't have to share, we're going to share anyway. And that's the type of thing that you start realizing that you're working with the right person.
And what about the structure? How did you set it up and the initial capital, if you can share, before the first deal?
Yeah, so it's a LLC, Delaware LLC, which is very common. The company structure is just Nate and I. We're just 50-50. So we're both members of the LLC. And then what we did was, in order to get things going, is not only did we put our own equity, sweat equity, everything in, we also brought on a few kind of friends and family to start building out, what we call co-GP partnerships, where he had some relationships, I had some relationships, and we brought on some folks that we like and trust, and they were the part of the initial capital to get HalBar moving.
And what about the first deal, and how long was the period from setting it all up, including the Nate's research he did before? You mentioned 2 years. How long was the period till the first deal, and how the first deal
Yeah,
went?
so the first deal was done in 2021. And that deal was done through our partnership with the incubator or accelerator, however you want to look at it, NCA. So our partnership with NCA is really kind of what got us moving in terms of the deal flow. And so in 2021, the first few deals were done all the way up until recently. And so when you think about, when you talk about the partnerships, right? So there's the partnership between Nate and I as HalBar. But then HalBar has partnerships with incubators like NCA, right? Good relationships with Christian Malik, who has built NCA, and really looking at their deal flow and being a part of their deal flow, right? And investing in the overall. So those are the I think the first kind of deals that we did.
What about the partnership? Maybe you could comment more between you and the NCA. Let's say there is a new player coming in. They have the capital, two guys like you. They have the capital. They have maybe a bit of experience, and they're like, okay, we see what HalBar is doing. We want to do the same thing. So, what is the NCA? What do they do? How does it work?
Yeah, that's a great question. So the way we do it is HalBar is really on the capital side. And so what we do is we look at the whole ecosystem of search, and we decide where do we want to place the dollars that we put together. Our first partnership was really with NCA, and that's still our most important partnership. And there, NCA, what they've done is they've built an incubator where they recruit, mentor, and grow entrepreneurs. And then when you look at their deal flow and everything, it fits into our investment thesis as well. HalBar is really designed to be the capital provider, right? So when I went back and, I was mentioning some of the things that we were trying to solve, right? So that institutions can come in. HalBar is where institutions can come in and invest, because the J curve is really then absorbed by NCA, right? Because they're the ones recruiting, mentoring, and growing and helping those searchers find deals. HalBar's money is really coming in at the moment of acquisition, right? So now our institutional partners are really coming in at the moment of acquisition, so they skip the J curve piece of it, right? Now they don't get the economics of that. That goes back to the accelerator, right, which is profitable by itself. But what you basically done is you split the farmers from the investors, right? And so that's really how the system is set up, so that institutions can come into this space. But you want partnerships like NCA, and you want hopefully others, right? Because there's a little bit of competition there, but you really want NCA to do well, because that's where the farming happens, right? So we can only invest as fast as they can bring on searchers, right? And so that's very important partnership.
Why did you decide to go this route instead of yourself looking for those mid-career managers on the one side, on the other side, talking to brokers who would bring you deals?
Good, great question. So when you look at the ecosystem, you really want the efficiency that an NCA brings, right? It's important that you have a place where they can do it in what I would call more volume, right? If I had to do it at HalBar, then I would have to take away resources from the fund, right, to then invest in that piece of it. And then the question is, how much time and energy do I have to put in to then create the deal flow, right? By doing partnerships, what happens is, and we partner not just with NCA, but we partner with other folks as well. NCA happens to be our biggest partnership. But when you look at the overall, we have to be able to get access to the searchers through a multitude of ways, right? Because the way I would describe this is, think about it this way: if I'm trying to produce coconut water, right? Well, if I'm the only one growing the coconuts, harvesting the coconuts, producing the water, it's very slow, right? But what if I had other people that were growing coconuts and I buy the coconuts from them, right? That fits within the quality of coconuts that I want, right? And that's why the partnership is so important. Otherwise, we wouldn't be able to grow this sector fast enough. And so for acceleration purposes, you really want to be where you have the capital folks, you want the searchers and accelerator program, and you want to put all that together.
So my question, how do you know, like before the first deal, that the coconuts are any good? I mean, the managers are good and the deal flow is good.
That's a great question, right? So we have to track it. We have to track it. And so far, we've done 20-something deals in partnership with NCA, but we've only had one exit so far. So the question of, are the coconuts good, is still debated so far. Now we obviously see the growth of EBITDA and how these CEO searchers are running the companies, and they're successful. So we know that they're going to do well. So we know that the coconuts are going to be good. But initially, you're right. I just no idea, right? We're just taking a chance that this whole investment thesis works. Now, after a few years, we can start seeing the momentum, and we start seeing the quality of searchers that NCA puts together. We see the quality of deals that they put together. And keep in mind that we're involved in that process as well. We're on the investment committee. So we kind of know what is to come, right? But the day in, day out, NCA does really the work of working with the searchers. HalBar really is focused on raising the capital to be ready for the acquisitions, because the acquisitions are coming, right? So we've done 22 deals. We've got 4 to 6 searchers now in LOI ready to go buy those deals. HalBar needs to make sure that the capital is ready to help with that.
That would have been my next question. Like, what is your biggest headache, or what maybe keeps you up at night? Is it people and talent? Is it deals, or is it the capital side?
It's all of the above. It's being in the investment world, in the private equity world. The biggest challenge is matching the timing of capital with deal flow, right? Sometimes the timing is off, and trying to match that timing is by far what keeps me up at night, right? So sometimes the deal flow isn't there, but then the money is sitting there, and you're trying to, like, oh my God, what am I going to do? I don't have anywhere to go with the money. In other times, it's like, oh my God, I have all these great deals. I don't have enough capital to match that. And what keeps me awake at night is matching those two so that it's a seamless flow, right? To make sure that when the moment of acquisition happens, there's capital ready to go, but not have capital sit too long where there's no acquisitions happening, right? Because that doesn't work either, and money goes stale, right? So it's a combination of both of those things, and making sure the continuum is smooth.
I was looking at the presentation you sent me. You're doing quite a lot of deals in Europe as well.
Yeah, so about 50% of our deals are in Europe, and the other 50% are in North America. And part of that is because NCA started in Switzerland. So their incubator started in Switzerland. So their first initial deals were all in Europe, and then they expanded to North America. and now they have an office in New York as well. And so as we progress, we are actually going to split those two market regions up. So the first time when you're doing it, you don't have enough volume, so you put it all together, right? So as we're starting to move forward, we're going to start now creating a fund specifically for North America, and then a fund specifically for Europe, and then in the expansion of that, potentially it could be Australia, Asia, South America. I mean, other possibilities at that point.
When we take first 5 deals, for example, how many of them were in Europe? How many of them were in US?
If you look at the actual numbers, it's about almost 50-50. So you look at the deal flows that we've done out of the 22, I think 10 were North American and maybe 12 were in Europe. But then if you look at the pipeline, I think the next 4 deals are all in North America. So you start balancing it back the other way.
And the first few deals, I think I asked it before, but the funding was friends and family, right?
So the first few deals that were funded was really friends and family offices that came together and funded the deal through syndication, co-invest is the best way to describe it.
What is the selling point of taking this capital from US to Europe, for example? Because this is don't they have questions like, don't we have enough deal flow in US to start with? Because the concept, it's not sure yet. You know, you're starting something. There's always things could go wrong. You don't have a track record
Yes.
doing this.
I think if you look at the market size, North America will end up being the bigger market for sure, right? Everything from the amount of searcher entrepreneurs that you can find, MBAs, the North American market is going to be bigger. But our origin started in Europe. And so because of that, right, that partnership started in Europe. And so we want to make sure that we still continuously do those deals. Now, as far as market cap and size, I think you're right. I think North America is going to end up being 70, 80. I don't know the exact number, but I think over time, you're going to find that there's more searchers and more deal flow on the North American side than on the European side.
Could we talk about the structure of the first deals? Do you acquire 100% of the business? How does it work with NCA? Like how is it all set up? Like how much do you own of the business and
Yeah.
and the liquidity as well?
So in general, when you think about the structure, the acquisition itself, right? So you have the total purchase price. And in general, you're going to have the aging founder take a small sliver of that as a continuation, meaning that they have to maybe own or finance it or whatever it is. So, for example, if you take a $15 million deal, the existing the seller, the aging founder, would probably take $1 million, $2 million of that 15, right, as a payout or something for the transition. The remaining amount, the $13 million or whatever it might be, is typically then split between debt and equity. So the debt side is going to come from traditional bank, private credit fund, something like that. The equity side is where we have been coming together as a syndication, right, to take that capital stack. Now, keep in mind that on the equity side, we have to share some of that with the searcher, right, and NCA as a partner, right? So about 20% of the equity side automatically is given to the searcher and NCA, and then the rest dollar-wise comes in from HalBar, other family offices, co-investment, whatever it might be. And that's really how the deals have been structured and put together.
And what about the exit strategy when it comes to investors?
Yeah, so here's the thing, right? We've only had one exit, so we're still new in the game of exit. However, what we're seeing is that there is a pretty good demand of people wanting to buy our companies after about a 5-year growth period, where you're going to have maybe a little bit larger private equity firm want the deal. Sometimes there's a family office that wants an operating company. And then sometimes there are strategic partners that might want the company. And those are going to be your most typical exits, I think, in this kind of portfolio. Now, on occasion, there might be something where you go IPO or something like that. But in general, I think the opportunity for exit is going to come from an independent sponsor that might want that size of a company, a small, mid-sized private equity firm, or a family office that wants an operating, or a strategic partner that wants to own it. So that you have about 4 or 5 different avenues of the exit itself.
And when it comes to growing those businesses post acquisition, do you have like a standard playbook? Because I was reading the presentation, like
Uh-huh.
a 13% increase in average of
Yeah.
EBITDA. That's you're doing very well.
Yes. So
Okay.
when you, so there, I wouldn't say there's a standard playbook because each of the searchers as entrepreneurs have to figure out where the growth is going to come from. However, we do find that there are some commonalities and some opportunities that are what I would call a little bit low hanging fruit that's easy to implement. So when you think about a company that is owned by an aging founder that has had it for 20, 30 years, right? Long period of time. There tends to be opportunities for us to institutionalize or bring in ideas around sales and marketing, right? Step number one to grow the overall revenue and then hopefully EBITDA. And the reason why is because when you think about a company that's been around for a while, they tend to grow more organically. They don't formalize the sales and marketing piece of it. So we look for opportunities there. The second opportunity that's somewhat common often in a company that's been around and has an aging founder is that they don't invest enough in the technology stack. Whereas the newer entrepreneur coming in will focus on more efficiency with technology stack. And by doing that, then a lot of times you can reduce costs or find ways to maximize revenue, right? And then finally, I think also a very important component of what we always do as part of our playbook is really around governance. So when you have a 72-year-old that's looking to sell a company, they've been used to being king or queen of their company. They call the shots. They do whatever they want. It doesn't work that way in our system where the CEO comes in. Yes, they're CEO and they have a lot of latitude to execute their business plan, but we do put a board around them. So it's very important to have a formalized governance to make sure there's some checks and balances with the entrepreneur. And I think that those are some common playbook strategies that we have. I don't want to go into any more than that because then it starts going into deal by deal in terms of where we see the opportunity. But in general, there is a little bit of a playbook that allows us to know that if we buy it from this aging entrepreneur and put in a new entrepreneur, we can do those things and just right there will give us some growth.
Do those companies have any synergies? Because this is quite a large portfolio already.
You know, I haven't seen where we have been trying to merge two companies that we bought or anything like that. If you look at our portfolio, we do lean a little bit heavy on industrial and manufacturing. So a good chunk of the portfolio is there. And some of that could be just because, we have searchers that are, mechanical engineers, electrical engineers. And then guess what? The people who own those types of companies tend to be older, right, from the baby boom generation. You typically don't find necessarily as much in the AI space or something like that where you're finding an aging seller. You can, but just not as common. So when you look at the overall, I think we lean a little bit heavy there. We don't really do roll-ups, right? That's not really part of our strategy. I know that a lot of folks like the kind of blue-collar roll-ups and those sorts of things. We really are looking to buy a company and figure out how to grow EBITDA in a systematic way so that we can then have a proper exit, right, for that company.
How much competition on deals? How much competition on
There's
talent?
always competition on deals. Yes, yes. It's interesting. The good ones you have to fight for a little bit. But what we tend to do is we tend to do a lot more outreach. So we would prefer, if possible, to find a deal before it even goes out to market, right? Because once it goes out to market, then everybody's looking at it. Independent sponsors, searchers, family offices, individual entrepreneurs, they all start looking at the same stuff. Not that we haven't found deals there, because we do have relationships with iBankers and different folks. But just as important is really the avenue around just reaching out. Yeah. Our searchers are typically 10 plus years in their industry. So they kind of know the players a little bit. And so they know who to go reach out to, who to cold call, and who to work their relationship with, right? And that's why it takes time. So it's not your standard like, oh, this person's already looking to sell. Oftentimes we'll reach out and we just have, we have to meet them, have lunch with the owner and just say, hey, are you thinking about exiting? And working those relationships so that, over time they're comfortable with the exit.
You are in this great position of seeing both like Northern America and Europe. How similar or different they are in terms of people, mm, acquisition multiples, post acquisition, like everything, because it's like black and white pretty much.
There's similarities and there's differences. When you look at the deals that are in Europe, when we do due diligence, we have to be more careful around regulations, especially if there is conversations about reduction in workforce, right? The rules there vary from country to country, and we have to be much more attentive to it. If you try to lay off somebody in Germany, it's a 1-2 year process. It's not like here in the U.S. where you give them 2 weeks notice and you give them a small package and they're gone. So those are types of things that you have to worry about from region to region. I think also the difference is that what we see is that the company's maturity tends to be older in Europe than in the U.S. and in North America, Canada. It just depends on where the industry is. Now, it's hard to quantify it completely at 22 deals because when you look at North America on the 10 deals, they're spread all over the place, right? So I don't know if there's any geographic differences within North America. But between North America and Europe, yeah, you can start seeing some differences. We do find that, from a characteristic standpoint, that in Europe, the owners that are selling, it takes a little more convincing. They are more ingrained into their business than in North America, where it's a little bit more transactional, it seems.
How do you personally, with Nate, manage it all? I mean, huge
Oh,
portfolio.
it takes a tribe. It takes a whole village. It's not just Nate and I, right? On the NCA side, they have 30 something people working there. When you look at the investment committees, and we do a lot of investment committees meetings because they're really part of due diligence. It's not just a yes or no answer. Nate sits on that. One of our co-GP sits on that. It takes people, right? It takes people to go through those deals, work with the searcher to make sure that the deal fits and it's what we want. The nice thing is having the partnership with NCA is they do a lot of the heavy lifting there. They really do, and they do a great job at it. So they help that entrepreneur get through whether or not a deal should be acquired or not. And so, but not easy by any stretch of the imagination. By the time somebody puts an LOI in and by the time we actually make a purchase, it could be like 3 months, but it could also be 10 months, right? So it's really unknown in terms of how long it takes to close the deal. And you can imagine for the searcher, it's frustrating sometimes because, they'll go through a deal 4 months later and the deal dies. They got to start the whole process over again. And so we have to manage those types of things.
Could you share maybe a bit more like a specific example, like post-acquisition success, like everything went according to the plan, it went maybe better, and maybe the opposite as well when things didn't go as well because there are lessons there?
Well, I think where we've had some challenges was the earlier acquisitions, where we were trying to figure out what type of entrepreneur we should put in, right? And so there was an instance where we had to remove a CEO, a searcher, right, and put in new leadership there. And it's not anybody's fault; it's just expectations, right? And I think it's taken us some time to hone into our model. And so I always tell people on searchers when people are applying for our search program with NCA and they want to apply, and I'm passing the name over to them, I tell them we're not really looking for that, brilliant, wild wild west cowboy that wants to be an entrepreneur. That's not really our profile. We're looking for mid-career folks that are, there to own something that they can tweak and grow from their expertise. And so I think we've had to learn that over time. I think initially it was like, okay, we can take anybody on. Anybody who wants to be an entrepreneur, let's go, right? But I think that they're much more selective today. And so when you look at a program like NCA, I mean, they get thousands of applications a year, and they only bring on 10 or 15 of these folks, right? So the landscape is very competitive, right? Very, very competitive to get into our program. Now, anybody can be a searcher, right? Anybody that's gone through MBA school that wants to be an entrepreneur, they can be a searcher. It's just not folks that we would want to do, right? And going back to my coconut analogy, we want to control the farms and what those coconut results are. We can't just take wild coconuts anywhere and throw them into our pool.
You've seen a lot of people, a lot of talent, a lot of experience. What
Uh-huh.
key attributes do you look for people you choose to invest in?
So when people go through the program, there's everything from personality profiling to experience analysis to making them do case studies, teamwork, just to see how they are. And what we found is there has to be a certain amount of um, certain characteristics. So number one is they have to have a certain amount of grit. And what I mean by that is they have to be kind of tough because the search process is not easy, right? It takes a lot of focus. There's a lot of no's, right? It's almost like a sales position where you have to get beat up a lot by people telling you no, 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 or you do so much work on a deal and then it doesn't work out. So I think that's important, right? Then you really have the skill set of leadership and vision, right? Because as a CEO, you have to have vision. You have to have the ability to say, okay, this company has been operating at this level for 20 years. What am I going to do in 5 years that'll really distinguish the growth and what happens? And so you really need to make sure that you have searchers that have a vision of how that growth is going to happen, and can see that opportunity, right? So I think that those are some key things. Then there's the technical skill side, right? You can't just bring anybody on. They have to be ready and prepared to be a business owner, and business owners have a certain perception of the world that's different than maybe everybody else, right? They can't be just a worker bee. They have to really think about, as an entrepreneur, the sacrifices, the suffering, the good times, the bad times, to be able to then grow a company, right? And so we try to look for that. We try to quote unquote test for it through interviews, through testing, and just trying to get a sense of, is somebody able to go through this whole process, right? And as an entrepreneur myself, and you've done this as well, that journey, a long journey. It's a bumpy road, not a smooth road whatsoever. It's not a highway, right? It's like going into the woods and at best maybe following somebody else's trail. So we want to make sure that it's somebody that can handle that type of rigor, if you will. Yeah, and ability to pivot, right? So what if things don't work out, and something breaks? What do you do? How do you fix it, right? And those become very important.
You mentioned a few times that you've done one exit. Could you talk more about this company?
Yeah, so that
How
exit
did it go?
happened. Yeah, that exit happened at the end of 2024 in December. It was a good exit. We got 45% IRR from it. It was a shorter hold than we anticipated, but the company grew the way it needed to. And believe it or not, the family that sold it to us wanted it back, and so they bought it back from us after the growth. So it was just kind of a unique situation. And we were like, well, we hit our numbers, so that's fine. And so we did a transaction there, right? And so that's our first kind of on the track record exit that we've done.
Obviously, you more, myself a bit less. We live and breathe this entrepreneurship, buying businesses, selling businesses.
Uh-huh.
What are your thoughts when it comes to next 5 to 10 years? Like, what do you believe is going to
Ooh,
happen? Lots of
okay.
tailwinds.
I don't have a crystal ball. Every time I try to predict the future, I've been wrong. But here's what I do know. Over the next 5, 10 years, you've got baby boomer generation reaching full retirement age, right? So the first baby boomers starting to retire actually just happened over the last 5 years previous. But when you look at the next 5, 10 years, now they're all into their 70s and 80s, right? And a lot of them were entrepreneurs and they've built very comfortable, good lifestyle type businesses. I think there's a huge opportunity for transition there, a huge opportunity. Um, what does that mean in terms of multiples? What does that mean in terms of buying opportunities or exit opportunities? I'm not quite sure. I really don't know. I know where we're buying at now, and that's roughly at 5x, but that varies from 3x to 6x, and then you average out to 5. I think it still comes down to the type of business, the longevity of that business, the growth opportunity of that business. Those are going to be very key conversations. Now, macroeconomically speaking, I know those trends are happening, but I do worry about, is there a global recession coming, right? Is there going to be more political or geopolitical unrest, right? With this whole conversation about Ukraine and Palestine, the Gaza and Palestine and all that. I think and then is China going to try to attack Taiwan? I mean, like there's some real geopolitical things that could really shake things up. Um, is there going to be another pandemic? I don't know. It seems like we're all hyper focused on trying to make sure that that doesn't happen. Um, but business goes on. Business goes on, and business has to adapt and has to move with whatever is happening, right? So you'll see those things happening. I think that's the beauty of this sector of entrepreneurship and business is that you have to survive. And so because of that, you make changes and pivots as the world is changing, right? As the world is changing. And so businesses that cannot do that die anyway. And so when I look out at the next 5, 10 years, I think the future is bright. I think that entrepreneurship is truly what is going to keep everything going, right? And when you think about that, that's what always has really driven the world and its economy, right? That's where big businesses grow from, opportunities grow from, job creation grows from. It all comes to really business and entrepreneurs.
Like you've had pretty fast last 2.5 years. You've done so much, bought so many businesses, made so many investments. If you'd start again today, would you change anything?
Oh, I'm not a hindsight kind of guy. I try to learn from the past. I think we make those changes as we learn from the past. If I think through, I don't know. I feel like you get those lessons, and that's why they exist. So I don't necessarily want to go back and change anything. But I think the past has taught us some things, right? Which is why we're now kind of moving in separating North America and Europe, right? As part of that. That's why the program and the NCA has shifted more into mid-career type entrepreneurs. So I think we're just honing our model down. So I wouldn't say I want to go back and change anything. I think it's more of what did we learn, and I think we're in real time right now adjusting to those learnings.
These were the lessons, actually. Great that you brought it up.
Yeah.
Now, when looking to the future, you have this crazy immigrant mentality. You found your thing. You seem happy and relaxed. You're
Uh-huh.
doing all right, very all right. You have a great track record now. What's next for you? What lifestyle wise and everything? How large do you want to build it, and how far you want to go?
Yeah, I would love to see this program be a global thing. Be a global thing. Because what we took was this really US idea of search funds where you have MBAs. We've done it in Europe, we've done it in North America now. I would really like to think that this program could be a international type program where we have entrepreneurs and searchers in Australia, Europe, South America, all over, right? All over. And to be able to create this ecosystem that allows for businesses to not have to die as the founder dies, right? And retires. And so I think that that's really the future. Now, to me, if you want to quantify that, I mean, that's a multi-trillion dollar asset class now, right? Which today is not even considered an asset class, right? It's just now starting because when you look at the MBA schools and all the top programs in the MBA schools, they're starting to have this as part of their curriculum and as part of their career path. That tells me that we're on the cusp and the beginnings of how this thing can be a real asset class down the road in the next 5, maybe 10 years, where you talk to a big pension fund or a retirement plan and they say, oh yes, you need to invest some dollars into ETA or search, right? It becomes a real category.
What do you learn? What do you study? I mean, you've grown a lot and you want to grow even further, and every level acquires a new skill set, new you, so-called. How do you stay on competitive?
You mean like personally or
Yes,
from a
yes,
business perspective?
personally.
Oh, personally, I mean, here, this is what I'm reading right now. The laws of human nature. So that tells you that I'm trying to learn more psychology, really, more than anything else, right? Because ultimately, it's about people, and I think people drive everything that happens, right? Whether it's even with AI and stuff like that, I think it's still people driven. Um, I think obviously I try to stay current in terms of political news, business news, those sorts of things. That's more of just every day, just checking in and seeing where markets are at and what's happening. From a long-term growth perspective, obviously reading things like human nature and understanding kind of those sorts of things. The book right before this one that I read was actually an AI book about how to humanize AI, so that we don't have Skynet taking over the world and it turns into Terminator or Matrix or something like that. And so I just read very different things. I love business, and so I tend to try to understand what's going on and ideas around business and what people are thinking about. I teach a class at one of the universities here in Austin, and so I try to stay on top of my curriculum that I teach. So just a lot of random stuff, a lot of random stuff to always stay ahead. I'm a big believer that you never stop learning. So there's always something new to learn. And even in my personal life, 2 years ago, I started playing piano because I always wanted to play piano, but I had no musical inclinations, and so that was now exercising a different part of my brain, and so I think that that's important, right? And then physically, you get older and it becomes harder to do certain things, and so you try to work out a little bit more and stay mentally and physically fit.
Okay, Jan, it's been a lot of fun. I want to respect your time. Quick
Yeah, thank
fire
you.
questions. What is your favorite book and what is the best investment advice you've ever received?
Oh wow, favorite book, huh? I There's a lot of favorite books. I would say that top of the list still is Seven Habits of Highly Effective People. That to me is still holds very true today, and I actually teach that to a lot of students because I think it's so important. Um, and maybe number two, I would say would be, and it's not one of mine. I've written two books, so I wouldn't put my books at the top. But as far as what I've read, I think number two would be probably Daniel Pink's Drive and really understanding motivation and how humans are motivated and what makes happiness and how that all works. So those are my top two right now.
And what about the best investment advice you've ever received?
Oh gosh, investment advice. Invest in people. When you're investing, always think about it that you're investing in people. And so the better you are at understanding people and understanding how to invest in people, that tends to be your biggest and best return.
Okay, this is the great way to end this conversation. Thanks a lot for doing this, Jan.
Yeah, you bet, Mick. Thanks for having me. It was enjoyable. Thanks.